Hello everyone, welcome back to Lulu's Real Way. I'm Lulu and I am so excited to have you here for episode 5 of our multifamily investing series. In episode 3, we talked about investment strategies, everything from cash flow to appreciation plays. Then in episode 4, we broke down the market research to figure out where the best opportunities are. Today, we're taking a step further to focus on 2 additional, very important pieces of the puzzle: property classes and neighborhood analysis. These 2 go hand in hand with the strategy we chose and the market research we've made to ensure the investment aligns with our goals. So let's dive in. Every multifamily property falls into one of 4 property classes: A, B, C, or D. Each class represents a different level of quality, risk, and potential for returns. Let's break them down. Let's start with Class A properties. Class A properties are top tier. They're new, high-end buildings in the best locations. They have modern amenities and high-income tenants. These properties are often in great neighborhoods and attract investors looking for stability. While they're low-risk properties, the returns are typically lower compared to other classes because of the premium pricing at sale, as you would typically acquire these properties for a higher initial investment, and you probably will have very little room to add value into them. Class B properties. Class B properties are slightly older, maybe 10 to 20 years old, but they're still in good shape. They're located in middle-class neighborhoods. They attract reliable tenants and often offer a balance between lower risk and moderate returns. For many syndicators, Class B properties are the sweet spot because they have a strong cash flow potential without so much value-add expenses. Class C properties. Class C properties are older. They're 20 to 40 years old. They're often located in working class neighborhoods. Now, these properties may need some updates or renovations, making them prime candidates for value-add syndicators. The potential returns are higher, but so are the risks, like tenants turnover and maintenance issues. Class D properties. And then there's a Class D property. These are properties in distressed areas, often with high crime rates and significant repairs needed. The price tag may look tempting, but they come with major challenges. As a syndicator, I personally focus on properties that balance the risk with the return potential. So Class D property is something I would probably avoid. But for an opportunistic investor, a Class D property could be a feast. Now let's talk about the connection between different property classes and different investment strategies, like cash flow and appreciation and value add. Property classes are a critical part of making those strategies work. If you're pursuing cash flow, then Class B or a stabilized Class C should do the work for you. For appreciation, meaning holding the property for a later time where the market prices rise and you sell at a higher price, Class A properties in hot markets can deliver a great long-term growth. Now, if your strategy is to add value, Class C property give you the best opportunities. In Class C properties, you can raise rents, make upgrades, and boost your returns. The key is matching the property class with your strategy. And this is what we do as investors. We ensure that every deal fits our financial goals and risk tolerance. Now let's talk about neighborhood analysis. You can have the perfect property class for your strategy, but if it's in the wrong neighborhood, it's not going to perform to its best. When I evaluate a neighborhood, I look at 5 major factors. I study demographics. Who lives in this neighborhood? Their ages, their income level. Are they renters or owners? I look at the job growth. Is the job market strong? Are there large employers nearby? If yes, how many large employers are there? People want to live where they can work, and more large employers means more stability in the employment market. I also look at crime rates. Tenants want to feel safe. A high crime rate can hurt the occupancy and the rental rate. I check out the schools. Strong schools are a huge draw for families, and they can bring in more demand. And lastly, I check the amenities and accessibility. Is the neighborhood near shopping areas, dining areas, parks, public transportation? These all add value to our neighborhood. We as investors for larger projects like multifamily need to see solid numbers for each of these categories. We use all the resources available. We need those solid numbers to come from different resources in order for us to make the best informed investment decision. Once you understand the property classes and neighborhoods, you can really start to see how they fit together. Let me give you an example. Imagine a Class B property in a growing suburban neighborhood. It's not brand new, but it's in a safe area with some job growth and good schools. That property could be a perfect example for cash flow strategy with a touch of appreciation. Here's another example. Think of a Class C property in an up-and-coming neighborhood. Maybe the area has new employers coming in, and you see an opportunity to improve this property and boost rents. That's a classic value add. See, the key here is to align the property class and the neighborhood with your goals and risk tolerance and your timeline. So here's the takeaway. Success in multifamily investing is all about understanding the property and the neighborhood. And together, they shape the risk and the reward for every deal. Now, if you've been following me, you probably know by now how to choose a strategy, research a market, and evaluate your properties in your neighborhoods. And that means you're well on your way to becoming an informed investor. If you're ready to invest or have any questions, drop them down in the comments below or reach out to me directly. I'm here to help you navigate this exciting journey. Thank you for watching Lulu's Real Way. Don't forget to like, subscribe to the channel, and share this video with anyone who's interested in multifamily investing. I'll see you in episode 6, where we'll be talking about building a syndication team. Keep an eye out for it because you don't want to miss it.